afternoon, everyone. Thank you for joining us today on this webinar, where we are essentially arguing in favor of India opportunity and how our current NFO of Edelweiss Multi-Cap Fund is best positioned to leverage this opportunity to give you the best outcome. Unfortunately, Deepak, our head of sales, could not join us today because of some business reasons. But in his place, I, Anirban Ghosh, who is part of the product team, will moderate this conversation. With me, there is Sahil Shah, who will be the co-fund manager for this Edelweiss Multi-Cap Fund. Sahil does not need any introduction. He has been associated with the larger Edelweiss group for very long back and has been with us in the AMC since 2015. Sahil steers our small cap fund, which has a very good track record, and is also co-fund manager for this Edelweiss Multi-Cap Fund, as well as the Focused Equity Fund. So before I pass the baton to Sahil, I'll set the context for our conversation, and that is why India. So rather than quoting numbers, I'll try to set out some differential aspects for which India is positioned to thrive in the next decade. It is a well-known fact that India is going to add another India to itself in terms of GDP numbers in the next decade. While there may be a few naysayers, but there are some aspects which are working in its favor. The most important aspect in this regard is the shift in policy approach of the Indian government. So if you could look 10 years back, you would see that most of the government policies were geared towards redistribution, which is basically giving cash transfer incentives to the poorer household to achieve economic equality. But in the recent times, this policy approach has moved to boosting investments and capex. Some examples of that you can see in production-linked incentives, which we call PLIs in common terms, introduction of the goods and services tax, and some level of corporate tax cuts. Another aspect which is helping India is the world becoming increasingly multipolar in recent times. It all started with the advent of COVID, and there has been some multiple geopolitical conflicts which has arisen in the world after that. Because of all this, bigger MNCs and corporates present across the world are looking to diversify their supply chains, and they cannot ignore India while thinking about all this. So if we assume that India, like China in the past, can become the factory for the world, then the fulcrum will shift from we being an exporter of service to becoming a manufacturing exporter. What it will lead to definitely is formalization of the economy, more and more people getting pulled into formal employment sectors. But what gets looked out in this is that it will also bring the global best practices into India, which will increase its productivity. The third aspect which I want to talk about is India becoming energy efficient. We all know that import of crude oil forms a great part of the export bill from India. But what we don't know that Indian government is making great strides to make the country energy efficient. We are already the largest solar panel manufacturer in the world. We are one of the largest manufacturers of wind energy, and our adoption of green hydrogen is among the highest in the world. So all this will lead us to India becoming energy independent, which will ultimately reduce our export bill. Having said that, there is another aspect that gets often talked about, is that China's parallel being drawn with India. Like how China was 15 years back, India is currently now. While in many aspects that is true, but there are certain things where India is by far leaps ahead. So if we think India now as how China was in 2007, but there are certain differences I would like to highlight. One of these is that when China was building its economy in 2007, it was building hard physical infrastructure. But nowadays that has become quite less relevant. Digital infrastructure has gone far ahead from rather than building public infrastructure, in which case I can highlight the example of Aadhaar and UPI, where India has made much progress. Another thing is that the median age of the working age population in India is 11 years younger than China, which leaves us, and it is growing also, so which leaves us with a longer runaway from growth from what China had 15 years back. So which companies will be beneficiaries of these aspects when all these things play together? To talk about that, I'll request Sahil to take over the conversation and present to us how technically he's going to manage the Edelweiss multi-cap fund so that you as an investor can benefit from these aspects. Over to you, Sahil.
Yeah, thank you, Anirban, and a very good afternoon to all the listeners. So what I'll do is I'll divide this discussion into 2 or 3 parts. One is I'll talk about India over next decade. Second, I'll talk about the multi-cap fund, and then again I'll hand it over back to Anirban, which then we can follow up with question and answers. So just first talking about India as over the next decade, I believe that India is at an inflection point as far as the growth is concerned over the next 1 decade. The reason is that if you look at last 20 years, we have seen that infra capex has been the theme from 2003 to 2011. Post that, it was more about services and consumption. I believe the next decade, or at least next 1 or 2 decades, will belong to a more inclusive theme where we'll see everything in India kind of participating in the overall growth that we'll see over next 10 to 20 years. So just to kind of talk about it, if you look at the consumption or the demographics of India, it is very much in the favor of Indian companies. So if you look at the demographics, the median age in India, as Anirban also mentioned, is at around 29 odd years. The working population, where the new people will get added to the workforce, will continue to happen over next 30 to 40 odd years. As we know that GDP growth is nothing but a function of growth in the working population, as well as the productivity of that working population. I think given the size of the economy that we are at, we will be amongst the top economies as far as the demographic dividends will play out over next 30 to 40 odd years. We have seen that in the case of China, where the demographic dividend started somewhere in mid-90s, which will possibly end in 2030s. We have seen that in Japan, where the demographic dividend started somewhere in early 60s, which ended somewhere in mid of 2005. So, I mean, there are examples after examples where over 30 to 40 years, this demographic dividends have been playing out, which have resulted into a very fast economic growth for such countries. If you look at India, the per capita GDP is at around 2,500 odd in terms of dollars. This is when you compare it with China or US. China was at this level of per capita GDP somewhere in 2007, US in somewhere in around 1960s. We believe that the skewness that we see in the India's per capita GDP is on a much higher side. Almost 15% of the population contributes to almost 55% of the India's GDP. As we see more manufacturing, as we see more workforce coming, more people joining the workforce, we will see this skewness going lower. If you look at 85% of the population has the per capita GDP, which is as close to $1,500. Now, as this per capita GDP of those 85% of the population moves closer to 2,500, 3,000 over a period of time, which will take the overall per capita GDP to closer to $5,000 to $6,000, maybe in next 10 years, that is when we will see a very high consumption growth or a consumer discretionary growth. As we have seen, as the per capita GDP increases, people shift their consumption pattern from just buying necessity products to discretionary to luxury products. So we will see a big shift, a large portion of population will see a big shift happening where they will see a lot of discretionary buying that will happen. So just to set the context, China from 2000 or mid 2000 to almost 10 to 15 odd years, the car market in China grew by 10x. That's a 20 to 25% growth, which is 10x in 10 years. Similarly, if you look at the QSR change, or let's say, for example, take example of McDonald's in the US, where in 1960s, in US had the same per capita GDP as what we have in India today. US had 500 McDonald's stores. Even today in India, we have roughly around 500 McDonald's stores. So there are a lot of similarities between what we see in terms of the stores that you see in when the per capita GDP of two countries are more similar. Today, US, with 1/5 the population of India, has 13,000 McDonald's stores as compared to almost around 500 stores that we see in India. So there is a large opportunity to grow, because if you look at QSR in India, or the quick service restaurant business in India, it is just 80,000 crores out of 4 lakh crore market, which is the market for it, which you can call it as a eating outside market in India. So whether you take air conditioners, where the penetration level is 10%, whether you take cars, where the penetration level is hardly 15 odd percent, whether you take QSR, where I just highlighted that how far are we behind in terms of the penetration that is there in US. I think as the 85% of the population, which is still at 1,500 per capita GDP, moves closer to 2,500, 3,000 over the next 10 years, we will see a massive shift in the consumption pattern that we are seeing. And this has got a lot of investment implications as far as the consumer discretionary stocks are concerned. So that is one big shift that we see happening in India over the next 10 to 20 years. The second is the manufacturing theme. So the manufacturing theme in India is essentially, if you look at the overall building blocks, which is capital, labor, land, infra, all of these things are in place in India. The labor cost is almost less than 1/5 that of China. So labor-wise, we are cheap. In different hierarchies, you will find different talent pools which is available in India. The investments that companies want to do, or when banks want to lend, both companies as well as banks balance sheet are in a very good shape as far as the lending is concerned, or as far as the putting up new manufacturing is concerned. So I think the building blocks are in place. Even the government has come out with the incentive program, whereby government is talking about the PLI schemes, which is almost around 2.5 lakh crores of incentives which governments want to roll out. This will add almost around or have an investment of around 3.5 to 4 lakh odd crores, which can generate revenues of around 7 to 8 lakh odd crores. So that is the kind of investments that we would see just because of PLI. So I believe that the building blocks, whether it is through incentives, whether it is through labor, whether it is through infrastructure, whether it is through corporate balance sheets, they are all in place. And that makes me believe that the manufacturing in India will do extremely well over the next many years. So just to highlight one point here is that basically what we have seen on the chemical side of the business over last 8 to 10 years, we have seen that the chemical companies in India have done exceptionally well. What had happened was that first China came out with the blue sky policies, where they talked about either the chemical companies have to wind down their units, or they have to kind of treat their effluents. What it did was that a lot of shift happened as far as the chemical is concerned from China to India. Now, when that happened, the companies which used to make 12 to 13% margins on an average are now making almost 18% margins. So their profitability has jumped by 50%. They have redeployed this excess capital that they have got because of this into kind of getting new growth. So this growth has led to a multifold increase in the overall market cap. Now, a similar situation or similar thing is now happening on the electronic manufacturing side in India. So in India, the electronic manufacturing in India is kind of at a cusp of an inflection point. Government has come out with a vision document which says that the overall total investments that is happening in the EMS space is at around $80 billion, which will go to almost around $300 billion. So that is the kind of revenue potential that the electronic manufacturing services will see over a period of time. So now, with that, a lot of these companies who are manufacturing this electronics will benefit out of this opportunity. So that is the manufacturing theme. The last thing I want to talk about is from a cyclical standpoint. I believe that even from a cyclical standpoint, we are at the early stage of the earnings growth cycle, or early phase of the economic growth cycle. The reason why I say so is basically because if you look at last 5 years, we have gone back to the car sales that we were doing in 2018. We are still 20% below as far as the two-wheeler sales are concerned. The housing cycle that we have seen since 2011 till almost till 21, almost 10 years, where the housing sales were subdued, has now started to pick up. The private capex during the same time frame was not doing well. The banking NPA cycle was there for a very long period of time, which was then followed by the NBFC crisis. So a lot of part of the economy, whether it was housing capex, whether it was private capex, whether it was banks NPA cycle, or whether it was car or two-wheeler sales, they've all got impacted over last 5 to 10 years. From a cyclical standpoint, this has all started to pick up over last 1.5 years. What it means is that typically, if you see in last 20-30 years, we have seen 5 years of good cycle and 1 year of bad cycle. We are just 1.5 years into a good economic cycle as far as either car sales is concerned, or housing sales is concerned, or even the private capex cycle is concerned. And that makes us believe that at least for next 4 to 5 years, we will see a very good growth in the cyclical industries, where we have seen a very subdued growth over last many years so far. Now, coming to the second point of discussion, which is the multi-cap fund. So basically, a lot of talk, a lot of chatter that we are hearing is around the small and mid-cap getting overvalued. While we are not of the camp that we believe that small and mid-caps can correct by 40-50%, unless and otherwise there is a hard landing in US. We believe that small and mid caps can maybe possibly correct by 10 to 15%, which is true for any given market. The valuations which used to be at a 10 to 15% discount in March 2023 has now become more like a 15 to 20% premium to their long-term averages, which we believe over next 6 months to 1 year, as the growth comes by, these valuations will start to look more reasonable. And hence, from a timing standpoint, from where we stand today, adding large caps to the portfolio also makes sense. And that is the reason why we are coming out with the multi-cap fund, not only to play or to have a multi-cap fund, which has large cap, mid cap, and small cap, but also from a timing standpoint, I believe that it is a good strategy to add large caps to the portfolio while remaining positive on the small and mid caps from a longer term perspective as well. So if you look at multi-cap fund, if you look at flexi cap fund, so while the name is flexi, the funds have not been flexible enough to kind of change their exposure towards large, mid, and small caps. So I believe that it is because of the benchmark considerations, where the benchmark itself has almost 70% of large caps and the remaining is small and mid caps. Whereas in multi-cap, the benchmark has around 50% of small and mid caps and 50% is large cap. If you look at the category average, it is almost 40% large caps and 60% small and mid caps. So it is a truly diversified market cap category, which is there in terms of the multi-cap category. The second point is that if you look at the returns of the multi-cap fund, over last 3 years, 5 years, or even 10 years, multi-cap as a category has delivered superior returns as compared to Nifty 500. So almost 200 to 400 basis points of alpha that Nifty or the multi-cap index has generated over Nifty 500 index. This is because it has got a higher proportion of small and mid caps, which is almost 60% or 50% of the overall index proportion. Now, this is something which I want to discuss in detail. If somebody wants to play India story over next 1 decade, the best way I think to play is through a multi-cap fund, because you will get industry leaders. Some of the industry leaders will be present in large caps, some of the industry leaders will be present in mid caps, and some of the industry leaders might be present in the small cap universe. Now, if you look at banks, for example, a lot of these big banks which have got a very strong liability franchise, which have got a very good branch network, which have got a very low diversified loan book, they are all present in the large cap space. Very few are there in the small and mid cap space. Similarly, a lot of the good IT companies are present in large and mid cap space. There are very few which are present in the small cap space. Similarly, when we look at consumer staples, a lot of the good branded companies like HUL, Nestle, which have got very good SKUs, very good brands in the market, they are all present in the large cap space. They are hardly present into mid and small cap space. So my point here is that some of the industry leading sectors are present in the large cap space, while some are present in the mid and small cap space. In the small and mid cap space, so for example, if you talk about consumer discretionary, when we are talking about AC penetration, when we are talking about auto components or auto penetration, or some of the consumer durable companies, all these penetration opportunities, most of them are available in the small and mid cap space. The largest AC manufacturer in India, which is Voltas, is a mid cap company and not a large cap company. So if you want to play penetration opportunities in India, where typically if your nominal GDP growth is 11%, these companies might grow at a much higher rate than GDP growth, and these companies are available in the small and mid cap space. If you look at FMCG companies, where you get very good brands, they will offer you stability, but the penetration is almost there. So typically there people will premiumize, but penetration opportunity is not much. Similarly, if you look at the QSR space, which we have been talking about, where you have players like McDonald's or Domino's, those companies where the penetration opportunity is again very high, these are available in the mid and small cap space and not in the large cap space. A lot of capital good companies, except for some of the larger capital good companies like ABB, Siemens, a lot of other capital good companies are available in the small and mid cap space and not in the large cap space. A lot of these emerging themes, chemicals, as I was talking about, was an emerging theme 8 years back, which was available in the small and mid cap space. Even today, as we speak, there is only one chemical company which has become large cap, while most of the other chemical companies are still mid and small cap. If you look at the total market cap of the top 7 chemical companies way back in 2013, it used to be somewhere around 5,000 odd crores for those top 7 companies, which today stands at almost around 1,20,000 to 1,30,000 odd crores. Despite this, these companies continue to remain small and mid caps. Today, if we believe that electronic manufacturing should be the next big theme in India over next 5 to 7 years, so those companies, all of them are available in the small and mid cap space. So if you talk about penetration opportunities, if you talk about emerging themes that are there, they are available in small and mid cap space. Similarly, the themes like unorganized to organized, where a lot of these building material companies are present, they are all available in the small and mid cap space. What it offers is that when you are playing these themes, whether it is unorganized to organized or penetration or emerging themes, typically these companies will grow at a much faster rate than the overall nominal GDP growth. And hence, if you want to play scale-up opportunities or high earnings growth opportunities, it is small and mid caps which will kind of offer those kind of opportunities as compared to large caps, which will offer you more stable companies. So I think multi-cap is a good combination of large caps and small and mid caps, where large caps will typically be around 40% of the portfolio, somewhere in the range of 35 to 45%, whereas mid cap and small caps will be around 60% of the portfolio. These are some of the stocks which in the existing funds we have identified at different points of time, which have gone to become or which have delivered very good returns over a period of time. This some of the names in the mid-cap space like Chola or ABB, which has done phenomenally well. Some of the stocks in the mid-cap space like Dixon, which has done phenomenally well for us, JB Chemicals, or some of the EMS companies like Dixon and Ember, which has done quite well for us. This is our philosophy or framework of investing, what we call as the FAIR framework. So F stands for forensics, A stands for acceptable price, I stands for investment style agnostic, and R stands for robustness of the business. When we talk about the FAIR process, in forensics, we kind of we do a lot of desk research. We do a lot of accounting quality checks. We look for companies which are able to convert their reported earnings into cash flows. We pay a lot of attention towards how the top management is being incentivized. A lot of work goes into how the capital allocation has been done in the past, whether there are any related party transactions which are there in the past or not. We also meet a lot of experts to understand about the companies, about the businesses, which is also part of forensics, as well as to understand the robustness of the industry as well as the robustness of the business. Ultimately, now coming to the robustness of the business, ultimately any company which is an industry leader, or whether it is a B2C company or a B2B company, it has to ultimately translate its earnings into cash flows. And finally, they should have a very good return on capital employed. And that is what we mean by robustness of the business. Acceptable price is very simple to understand. Typically looking for companies which have got the same or good management quality, above average businesses, which are available at a better valuation as compared to companies which are available at a higher valuation. Investment style agnostic is basically where we don't focus on only one style of investing. We don't say that we'll go only after value, we'll only go after GARP, or we'll go only after high quality businesses. We have a blend of everything into our portfolio, which will make returns more consistent rather than being dependent on a particular investment style. So this was what we do. This is what we don't do. We don't take outside sectoral bets again to have more consistency in our performance. We don't take macro calls, and hence we also don't take any cash calls in our portfolios. So this is what we don't do. So I think finally, I would like to say is that given our core strength in the small and mid caps, I think a truly market cap agnostic fund that we are now launching that will allow our clients to invest in India's next decade of growth. And we believe this should be a part of the client's core portfolio. So with that, I'll just hand over the floor to Anirban.
Thank you, Sahil, for giving such a generous argument in favor of India and how we can, in this multi-cap fund, we can rely on the long-term story of small and mid-caps, and to add to that, take advantage of the large-cap stocks as well. So while we move into the Q&A round, we request the audience to post their questions in the comment box. And while you do so, I'll rather pose a few questions to Sahil from my end as well. So Sahil, while we touched upon it, I would like to ask you that what merit does multi-cap fund have over the flexi-cap category? Because as we know that, multi-cap funds were managed like the current flexi-cap funds till SEBI brought its recategorization circular in, I think, somewhere 3-4 years back. So now at this juncture, like the way multi-caps are defined and the way it's supposed to be managed, what merit does multi-cap fund have over flexi-cap category?
I think, see, the small and mid-cap over next 5 years will have more growth as compared to the large cap. So if let's say large cap earnings would grow at typically at 13 to 14 odd %, small and mid caps would typically have a growth rate which is at least 4 to 5% higher than large caps. Now, in that situation, given that we know that share prices over a longer period of time are a function of earnings growth, And if we want better returns, small and mid caps allocation has to be on the higher side. Now, multi-cap is the only category within all the different categories, except for obviously small and mid-cap, which are only small and mid-cap fund. Uh, within the within the diversified market cap category, flexi cap, multi-cap is the only category which offers you 50 to 60% of small and mid caps, and only 40% is large cap. It's a good blend of stability as well as higher earnings growth that one would see over a longer period of time. In FlexiCap, as I mentioned, while the name is Flexi, most of the funds don't take advantage of it being a Flexi category, and that is basically driven by benchmark considerations, where benchmark itself has around 70% in the large cap. So that is the reason why I believe that multi-cap category should do extremely well over next 4 to 5 years.
Okay, so I would, taking cue from you, I would also like to believe that, I mean, if we take the size of the fund into consideration and we are looking at large flexi cap funds, that might also act as a deterrent for them to take exposure to small and mid cap space, or probably you will be able to better explain, I mean, if that is so.
Sorry, what is your question? You're saying that
the question is saying that if we are looking at very large flexi cap funds, yeah, and so for them to move to invest in, you know, high performing small and mid cap stocks, should it work as a deterrent for them as the size of the fund grows larger? So while they say themselves as a flexi cap, they will be, you know, kind of stopping to take exposure.
I think while size of the fund will be a deterrent to taking a very large position in the small and mid cap space, I think a bigger factor that is driving is what I kind of referred to was the market cap consideration, or the index consideration, where NSE 500 itself has around 70% in large caps, and also the peer set consideration, because ultimately a particular category will be ranked within that particular category. So I think the peer set pressure as well as the benchmark where it is today, that is I think one of the major factors where people are not taking a very high exposure towards small and mid caps in the flexi cap fund.
Okay, so we have received a question from our audience, and I'll pass that on to you. So I'll reframe the question for the ease of understanding of the general audience. So do you think that the SEBI regulations and the benchmark considerations are sufficient enough that you in this multi-cap fund do not take the flexi cap approach?
Yeah, absolutely. So if you look at the mandate of the fund, at least 25% of the fund has to be invested each into large cap, small cap, and mid cap. So by definition, I cannot be going less than 50% into small and mid cap as a mandate. Okay. So I think as you rightly pointed out, that because of the mandate that has been given to this fund, as far as and also the benchmark which is there for the fund, I believe that the small and mid cap proportion will always stay higher in this multi cap category.
Okay, thank you, Sahil. So moving on to the next question, my interest lies in the mid and small cap space, in which you also have some deep expertise. So the mandate of the funds makes you invest in the mid and small cap space to the extent of 50%, right? So what are the pockets of opportunities that you see, you know, in the mid and small cap space? And do you see, I mean, you have already touched upon this, but still I'd like you to throw light once again. Do you see froth here? Seeing the valuations now where they are currently?
So yeah, valuations are on a higher side by around 15 to 20% from their own historical average. Small caps are trading closer to 22 times in terms of price earnings multiple. Mid caps are trading at somewhere around 24 times as far as the price earning multiple is concerned. But if you look at FY24 growth projections, which is at around 20 to 25%, if that growth comes by, then obviously this multiples, which looks at 22, 24 times versus an average of 18 times, will come more closer to the average at maybe at around 19, 20 times 6 months from now. given that
Okay.
these are all trailing 12-month multiples. 6 months down the line, these multiples at an index level will look more closer to less than 20 times. And that would not make market look very, very expensive. So just to go back into not very distant history, but very in 2021, after the post-COVID rally that happened, again the small and mid caps outperformed by a massive margin to large caps. In October 21, the valuation of the small and mid caps was at around 26, 27 odd times. For almost 1.5 years, the valuations or the small and mid caps had underperformed the large cap category by around 13 to 15 odd percent. Even during the same time, while there was a minor correction at an index level, maybe a slightly more correction at the stock level, the earnings went up by 30-35% during the same time frame. What it did was that the multiples which were looking expensive were almost 30-40% above the average, in the end of 2021. At the start of 2023, they started looking below the average, right? And that is the reason why we have seen, apart from the flows that we have seen in mutual funds as well as from the FII side, the markets which used to trade at 16, 17 times are now available at 20, 24 times. And in the meantime, the markets have gone up by 30 to 40 odd percent. So these things about overvaluation in the short term might play out, but also if we focus on earnings growth, the other factor is that while we are looking at 10 to 15 year average valuation, but what has changed over last 10 and 15 years is the cash flows of these small and mid cap companies, which has materially improved. Second is the debt to equity or the debt to EBITDA, the balance sheet profile of the companies on an average has improved materially from what it was, let's say, 10, 15 years ago. So if you take into account those factors, balance sheet improvement, better cash flows, and then in that context, if you look at valuation multiples, then it is not very, very expensive, in my opinion. So that hopefully answers the question of what most people right now have, that are we into frothy zone of valuation or not?
Okay. Thank you, Sahil. We know that you will run a sector agnostic strategy in the fund. But we have a question from the audience which says that, do you have a number of stocks in mind while you build the portfolio?
Typically, I mean, this will be a diversified strategy. So 60 stocks plus minus 10 would be the range of number of stocks that we will have in the portfolio.
Okay. Okay. And which sectors are you currently overweight in your other funds, like existing funds?
So we are overweight on capital goods across most of our funds. We are overweight housing, whether we are playing it through the direct housing plays, which is the first derivative plays, or through building material companies, or through some of the housing financiers that we are looking at, or through cement companies. These are the 4 ways to play housing. So we are quite positive on housing as a space. As I was saying, that we have witnessed a long phase of a very subdued housing cycle, which over last 1.5 years has improved quite materially. And hence, we will see that a lot of these subsectors of housing, whether it is building materials, cement, or housing financiers, at least over the next 2 to 3 years, they should do extremely well.
Okay.
So, one is capital goods, second is housing, and third is automobiles, which we are quite positive on.
Okay. So keeping aside these overarching themes, if I see now in the industry, there may be around odd 22 to 27, multi-cap funds running in the market with around 1 lakh crore of aggregate AUM. So have you ever thought, like, how will you position our multi-cap fund compared to those, apart from these overarching themes?
So, see, I mean, there is no way, I mean, it is going to be a plain vanilla product. I mean, it is not going to be, we don't have a differentiated approach as far as running a multi-cap fund is concerned. It will be a plain vanilla approach where 40% will be large caps, 60% will be small and mid caps, It is just our expertise in small and mid caps, where we have been running our mid cap funds in the last 15 years, small cap funds in the last 4.5 years, and it has a more than better or a better track record as far as the small and mid cap is concerned, which is going to be a large portion of the multi cap fund. It is just the expertise that we have in the small and mid cap space, I think, which will kind of differentiate us.
Okay. Okay, thank you, Sahil, for answering a question. While we wait for further questions to come, I'll rather highlight on two other aspects uh, of us as an AMC, as well as a facility that we have shared for this NFO. So just to highlight to the general audience that in the past 5 years, Edelweiss has a tremendous track record for NFO. So if you look back in the past three years odd, we have launched these three funds at the right opportune time, which speaks volumes about us tracking the markets. And of course, you can see the results and outcomes over here on this slide. So the Edelweiss Small Cap Fund, the Edelweiss Focused Equity Fund, and the Edelweiss US Tech Fund of Fund, they all came at a time when either, so for the Edelweiss Small Cap Fund, it just came at a time when the NBFC crisis was over in 2018 and the market was slowly coming out of that crisis. Edelweiss Focused Equity Fund was launched last year, just before the time the market went on an upward spiral. And Edelweiss US Tech Fund of Fund was launched at a time when, if you could see, that the US tech industry was down. So from there on, these funds have appreciated to give their investors a great generous outcome compared to their benchmarks as well. So that is one aspect. Another aspect which we want to highlight and which we have been, kind of telling our partners and investors alike is that we have introduced STEP facility in this NFO, which is basically you as an investor, as per your risk appetite, if you fear giving lump sum investment into the NFO, then you can, kind of distribute your investment in the next 6 months time, where when you start your investments in the NFO, first 20% of your money will be invested in lump sum in the first installment, and then the next 5 installments will happen on a trigger facility. So basically the next 5 investments will be distributed over the next 5 months. When they will be invested is on the second last working day of the month, or if the market falls 3%, from the allocation NAV, whichever happens earlier. So in 6 installments, your entire investments will be distributed into the NFO. 20%, I repeat, will be invested in lump sum in the first installment, and the next 5 installments will go in 16% in each bucket. And the trigger will happen if the market falls 3% from the allotment NAV, or on the second last business day of the month, whichever happens earlier. Yeah, so I wanted to just touch upon these two topics. If in case your risk appetite is such that you want to invest into the fund through STEP facility, or if you want to know that whether, if you want to at least have a look whether the timing is right for you to invest in this NFO. So with that, I think we have no more questions, so we can break out from the session. Hope we have been able to give a sneak peek into how we will manage the fund and how India boards as an opportunity. So just in a lighter note, if you want to think how the Edelweiss multi-cap fund will look like, I sometimes draw an analogy with a thali. Have you ever had a thali? Have you ever traveled across India for work and leisure? Thali is a thing where you are served selection of Indian foods in the best of the proportions, so that at the end, the objective is simple. You have a satisfying meal and, you have a satisfying outcome. So in the same way, we are trying to serve you India on a palette through the Edelweiss multi-cap fund, where you have best of the Indian opportunities served in a portfolio where you invest and take advantage of India's next decade. Thank you, everybody. Hope you had a great session. Thank you. Thank you, Sahil.
Yeah, thank you, everyone. Thanks, Anupam.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.